In 2008, Blackstone bought 7,000 homes. By 2013, they owned 40,000. Today, Invitation Homes, their little real estate pet project, controls over 80,000 single-family houses across America. American Homes 4 Rent has 59,000. Progress Residential sits at 91,000. And here's the fun part. Those are just the 3 biggest players. There are now over 300 institutional landlords quietly buying up neighborhoods while you're scrolling Zillow on your phone, wondering why that 3-bedroom in Phoenix somehow has 17 offers. The total count? North of 700,000 homes. That's not a portfolio. That's a small country's worth of real estate. So here's my question. When did your shot at homeownership become Wall Street's monthly dividend check? I'm going to explain exactly how this happened, why it's accelerating, and what it means for anyone still clinging to the idea that real estate is how normal people build wealth in America. Because, spoiler alert, the game changed, nobody told you, and the house always wins. Let me start with a story. Imagine you're playing Monopoly. Standard rules. You're buying properties, building houses, trying to bankrupt your brother-in-law. Normal Tuesday night, but then someone shows up with a briefcase full of cash and says they're changing the rules. They can buy entire color groups in one turn. They can pay in credit they created themselves. And when they land on your property, they don't pay rent, they just restructure the deal. You're still playing Monopoly. They're playing a different game entirely. That's what happened to American housing. Here's what actually went down. After the financial crisis, millions of foreclosed homes hit the market. Regular people couldn't get mortgages because banks were terrified. But institutional investors, they could borrow money at rates so low, it was basically free. The Federal Reserve had slashed interest rates to 0 to stimulate the economy. What they actually stimulated was the largest wealth transfer in modern history. Blackstone walked in with $7 billion in 2012. Not their money, by the way. Investor money. Pension funds. Sovereign wealth funds. Rich people who wanted a safe return. And Blackstone told them, we're going to buy thousands of foreclosed homes, rent them out, and securitize the rental income. You know what securitize means? It means they bundled those rental payments into bonds and sold them to other investors. The same financial engineering that caused the crisis in the first place. Except this time, instead of mortgage-backed securities, we got single-family rental securitizations. Different name, same playbook. Now you might be thinking, okay, but that was over a decade ago. Surely this has leveled out. And that's where it gets really interesting. Because what started as opportunistic buying during a crisis became a permanent business model. These companies figured out something crucial. Single-family rentals could be run like factories. Invitation Homes didn't just buy houses, they built an entire operating system. Centralized maintenance, automated rent collection, dynamic pricing algorithms that adjust rent based on local market conditions every single month. They turned mom-and-pop landlording into industrial-scale asset management. I've read their earnings calls. I'm that guy. And let me tell you what they say when they think you're not listening. They talk about rent growth. They talk about operational efficiency. They talk about capital deployment strategies. What they don't talk about is housing. Because to them, it's not housing, it's yield. Your rent is their return on invested capital. Your need for a place to live is their quarterly earnings report. Let me give you a concrete example. Phoenix, Arizona, 2012, median home price was $165,000. Blackstone comes in, buys 4,000 homes in 18 months. Fast forward to today, median home price is $430,000. Did Phoenix suddenly become Manhattan? No. But when institutional buyers absorb inventory at scale, they create artificial scarcity. Less supply, same demand, higher prices. Economics 101. Except now, it's weaponized. But here's the problem you think exists. Wall Street is buying all the homes and regular people can't compete. That's true, but that's not actually the problem. The real problem is what happens next. See, when you own a home, you have an incentive to maintain the neighborhood. You care about schools. You care about crime. You care because your net worth is tied to that zip code. But when a private equity fund owns the home, they have different incentives entirely. They care about cash flow. They care about exit multiples. They care about how the asset performs in a portfolio context. Here's a fun piece of data I pulled from a Metro study report. Institutional landlords are 3 times more likely to file evictions than small landlords. Not because they're evil, because their business model requires maximum occupancy and minimum friction. You're 30 days late on rent, automated eviction notice, no negotiations, no grace period. The algorithm doesn't have empathy. It has a fiduciary duty to shareholders. And before you say, well, that's just capitalism, let me show you the next level. Because it's not just about owning homes, it's about controlling markets. American Homes 4, Rent owns 59,000 homes. Sounds like a lot. But here's what matters. In certain zip codes, in Dallas, Atlanta, Charlotte, they own 20 to 30% of all single-family rentals. That's not a landlord. That's a cartel. When you control that much inventory in a specific market, you set the rent. You don't respond to market rates, you create market rates. Every other landlord in that zip code looks at what you're charging and prices accordingly. You're the benchmark, the price floor, the guy who decides what housing costs. I talked to a property manager in Charlotte off the record because these people are terrified of getting blacklisted. And he told me this. We used to set rent based on what we needed to cover costs and make a reasonable profit. Now we set rent based on what Invitation Homes is charging 3 streets over. Because if we go lower, we're leaving money on the table. And if we go higher, we can't compete. That's not a free market. That's price leadership. Now here's where the psychology gets fascinating. Because you'd think, okay, Wall Street owns a bunch of rentals, they charge high rent, life goes on. But that's not how this works. The presence of institutional landlords changes the entire market structure. It's like introducing wolves into an ecosystem. Everything adjusts. Small landlords start acting like big landlords. They adopt the same strategies: dynamic pricing, aggressive evictions, minimal maintenance. Because if they don't, they can't compete on returns. The institutional playbook becomes the standard playbook. The whole market shifts. And here's the kicker. Homeowners start thinking like landlords too. I see this all the time. People buy houses not to live in them, but to rent them on Airbnb or to hold as investment properties. Because they've been trained to see housing as an asset class, not a place to live. Wall Street didn't just buy homes. They changed how America thinks about homes. But now you might think, this is terrible. But surely it can't last forever. Markets self-correct. Competition increases supply. And that's technically true, except for one tiny detail. These companies aren't just buying existing homes. They're building new ones. Invitation Homes has partnerships with home builders to construct entire neighborhoods, specifically for institutional rental. Build-to-rent communities. Hundreds of houses, same floor plan, same finishes, same landlord. It's like an apartment complex, except it's single-family homes with little lawns and white picket fences. The aesthetic of ownership with none of the actual ownership. The builders love this. Instead of selling homes one by one to individual buyers dealing with financing contingencies and picky families who want the wrong countertop, they sell entire developments in one transaction to a single institutional buyer. Guaranteed sale. No marketing costs, no risk. The builder gets paid, the fund gets inventory, and you get to rent the American dream at $2,300 a month. Let me tell you what I think is really happening here. And this is where my 10+ years running a business around accountants and fiscal lawyers pays off. Because I've seen this exact structure before, not in housing, in corporate debt. There's a concept called capital stacking. You take an asset, you slice it into different layers of claims, senior debt, junior debt, preferred equity, common equity, and you sell each layer to different investors based on their risk tolerance. The senior debt holder gets paid first, but gets lower returns. The equity holder gets paid last, but gets higher returns if things go well. It's how private equity works. It's how leveraged buyouts work. And now it's how housing works. Invitation Homes doesn't own their houses outright. They're leveraged. They borrowed billions to buy those homes. And they securitize the rental income to pay back investors. So you've got bondholders who get the safe, steady rental payments, and you've got equity holders who get the upside if home prices appreciate. The house isn't a house. It's a structured financial product. You're not a tenant. You're a cash flow stream in a collateralized debt obligation. And here's what that means practically. These companies can't afford for rents to go down. They have debt service. They have return hurdles. They have investors who are promised 8 to 10% annual returns. If rents drop, the whole structure collapses. So rents don't drop, they only go up. It's not a conspiracy, it's math. The capital structure demands it. I want to give you a specific scenario. Let's say you're looking at a house in suburban Atlanta. 3 bedrooms, 2 baths, decent school district. Invitation Homes bought it in 2014 for $215,000. They put down about 30% equity, $65,000, and borrowed the rest. Today, that house is worth $420,000. They've made $205,000 in appreciation. Nice. But wait, they've also collected rent for 11 years. Let's say average rent was $2,000 a month. That's $264,000 in gross rental income. Minus operating expenses, property tax, insurance, maintenance, management fees. Let's call it 40% of gross rent. So they netted about $158,000 in cash flow over 11 years. Total profit, $363,000 on a $65,000 equity investment. That's a 5.5x return. In 11 years, that's a compound annual return of over 17%. You know what the S&P 500 did over that same period? About 13%. They beat the market with leverage, using your rent money. And this is why they're never selling. Why would they? The house is a machine that prints money. As long as rents keep going up and home prices keep going up, they just refinance, pull out equity, and buy more houses. It's infinite. It's beautiful. If you're them, here's a fun conversation I imagine happening in a Blackstone conference room. Sir, people are upset we're buying all the houses. Are they paying rent? Yes, sir. Then they're not upset enough. Okay, maybe that's not a real conversation, but you get the point. The incentive structure doesn't care about your feelings. It cares about return on equity. Now let me address the obvious objection. Some of you are thinking, this is only 700,000 homes out of 85 million single-family homes in America. That's less than 1%. How much impact can that really have? And you're right. Nationally, it's a rounding error. But housing markets aren't national, they're local. And in the markets where these companies operate, Sunbelt cities, growth metros, places people are moving to, they own 5 to 10% of the rental stock. In specific neighborhoods, it's 20 to 30%. That's enough to move the market. That's enough to set the price. It's like saying billionaires are only 0.1% of the population. How much influence can they have? Well, quite a bit, actually. Here's the thing nobody wants to admit. This isn't illegal. It's not even unethical by traditional standards. These companies are doing exactly what capitalism tells them to do. Find an inefficiency, exploit it at scale, generate returns. The system is working as designed. The problem isn't the players, it's the game. And the game is this. We decided as a society that housing should be an investment. Not a right, not a utility, an investment, which means we created incentives for people to treat it like one, buy low, sell high, extract maximum value. And then we act shocked when sophisticated investors show up with billions of dollars and do exactly that, but better than you ever could. You know what's wild? I have multiple hundreds of thousands of dollars invested. I've looked at these companies, Invitation Homes, American Homes, For Rent. I've read the prospectuses. And you know what? The returns are good, really good. If I didn't have principles, or at least a vague sense of how this ends, I'd probably buy in. Because from a pure investment standpoint, It makes perfect sense. Stable cash flow, inflation protected, tax advantaged. It's a better investment than most bonds and almost as safe. That's the problem. It's a good investment because it extracts wealth from renters and transfers it to investors. The better it works for them, the worse it works for you. That's not a bug. That's the feature. So what do you actually do about this? Because complaining doesn't pay rent. First, understand that the traditional path to wealth through homeownership is broken in many markets. Not all markets, but many. If you're in Phoenix, Atlanta, Charlotte, Dallas, Vegas, the places where institutional ownership is concentrated, you're competing against entities with infinite capital and a lower cost of capital than you'll ever have. That doesn't mean don't buy a house. It means be realistic about what you're getting into. You're not just buying a house. You're entering a market controlled by players with completely different incentives than you. Second, if you can't beat them, don't join them, but understand them. These companies are playing a long-term game. They're betting on continued urban migration, continued rent growth, and continued access to cheap debt. If any of those assumptions break, the model breaks. Interest rates go up, harder to finance new acquisitions. Recession hits, rent growth stalls. Remote work reverses, demand in Sunbelt cities drops. I'm not saying that will happen. I'm saying their model has vulnerabilities. And vulnerabilities create opportunities. Third, get really comfortable with the idea that housing in America is now a financial asset first and a place to live second. That's the world we're in. You can be mad about it, I am, but you can't ignore it, which means you need to think like an investor, even if you're just trying to find a place to live. What's the cost of renting versus buying? What's your opportunity cost if you tie up capital in a down payment versus investing it elsewhere? What's the expected appreciation? Run the numbers. Don't buy based on emotion or what your parents told you. Buy based on math. Because here's what I've learned after 10 plus years in business, surrounded by people who structure deals for a living. The people who win aren't the ones with the best intentions. They're the ones who understand the incentives. Wall Street figured out that housing is a better investment than commercial real estate because people always need a place to live. They figured out they can leverage it higher because it's backed by rental income. They figured out they can securitize it because investors are desperate for yield. And they figured out they can scale it because technology made property management industrial. You can be angry that they figured it out, or you can accept that they did and adjust your strategy accordingly. Lazy investing built more fortune than crypto memes. And right now, the laziest investment in America is buying something, renting it out, and watching the value compound while someone else pays your mortgage. Wall Street didn't invent that. They just industrialized it. So here's where we are. Institutional investors own less than 1% of all homes, but control the pricing in the markets that matter. They've turned housing into a structured financial product. They've changed the incentive structure for everyone. And they're not going anywhere because the returns are too good and the capital is too cheap. The house you grew up in thinking you'd own one day, it's in someone's portfolio now. Ticker symbol INVH, trading on the New York Stock Exchange, delivering reliable returns to pension funds and sovereign wealth funds and rich people who've never seen the property and never will. That's not dystopian. That's just Tuesday in 2026.